All right, let's talk about DraftKings, because their Q3 earnings give us a truly wild day. First, their stock absolutely tanks on a shocking earnings miss, and then, somehow, it skyrockets to close up nearly 9%. It's a massive reversal. So, what happened? How does a company turn a terrible quarter into what they're calling great news? That's the puzzle we're going to solve today. Let's get into it. Okay, so the story really kicks off with this. An incredibly bold statement from CEO Jason Robbins, right at the top of the earnings call. Now you got to remember, he said this right after the company posted a big miss and slashed their guidance for the year. You hear that and you think, wait, what? Most bullish ever? How does that even make sense? But honestly, understanding this quote, that's the key to understanding the entire day.
And this slide just lays out the paradox perfectly. It's a real tale of two tapes. Over on one side, you got all the bad news, right? Revenue miss, earnings miss, they even cut their guidance. Naturally, the stock gets hammered in the pre-market, down around 8%. But then, look what happened by the end of the day. A complete 180. The stock finishes up almost 9%. So the billion-dollar question is, what on earth did the market hear on that call to make it completely change its mind like that?
So here's how we're going to break it all down. First, we'll hit the earnings numbers that caused all that initial panic. Then we'll get into management's bull case, the story that turned everything around. We'll also cover the big debates from the Q&A, and we'll wrap it all up with our take in the next call. All right, let's dive right in. First, let's look at those numbers that initially just spooked everybody. So the first big red flag was the bottom line, adjusted EPS, a loss of 26 cents. Now you got to know, Wall Street was looking for them to basically break even, maybe eke out a penny of profit. So yeah, this was a pretty big miss right out of the gate.
And things didn't look any prettier on the top line either. Revenue came in at just over $1.1 billion. The consensus estimate, that was way up closer to $1.3 billion. I mean, a miss on both revenue and earnings, that is usually a recipe for an absolute disaster for a stock. So what was their excuse?
Well, management had a very specific answer. They basically said, hey, we ran into a $300 million headwind because the bettors got lucky. They called it customer-friendly sports outcomes, which is just a fancy way of saying an unusual number of people won their bets, especially in some big NFL games. The house just didn't win as much as it usually does. And that, they said, was the main reason for the bad quarter.
Okay, so you've got this really ugly picture painted by the headline numbers. So how in the world did management convince Wall Street to just ignore all that? Well, this is where their bull case comes into play. They basically built their argument on four main points. Number one, they said the core business is actually growing faster than ever. Two, they've got a new product coming called Predictions. Three, they claim the long-term profitability is getting structurally better. And finally, number four, they put their money where their mouth is with a huge capital return plan. And this is the proof they offered up. Their whole message was, look, forget about the one-time bad luck this quarter and look at the real trends. The handle, which is just the total amount of money people are betting, was up a strong 17% in October. Their online casino business, up 25%. And if you look at the big leagues, both NFL and NBA betting were growing by double digits. The underlying business, they argued, is humming. And then came the big one, the mic drop, really. The board doubled their stock buyback program to a whopping $2 billion. Look, that is a huge vote of confidence. It's management screaming from the rooftops that they think their own stock is cheap and they're ready to back that up with a ton of cash. This, right here, is what made investors really sit up and pay attention.
All right, so after management made their case, we got to the Q&A with the analysts. And this part was super important, because this is where the tough questions get asked. And really, two big topics kept coming up: volatility and this new predictions thing.
So, the first big question was all about risk. Parlays, where you bet on multiple things happening at once. They're super profitable for DraftKings until they're not. When bettors win a big parlay, the payout is huge. So analysts were basically asking, hey, by pushing these so hard, are you guys making your business way too unpredictable? And the CEO didn't really back down. He basically said, look, this is the business we're in. It's going to be volatile, especially when you have something as massive as the NFL, where a few games can swing everything. He said their focus isn't on any single quarter, it's on maximizing value over the long haul. And he tried to calm everyone down by putting it in perspective, saying the total hit for the year from all these unlucky outcomes was only about 5% of revenue. Basically, we can handle it. The other big thing everyone wanted to know about was this new predictions market. This is a new thing for them, moving into that whole world where you can bet on, Well, pretty much anything. And investors were like, okay, what's the plan here? How are you going to do this? And their playbook was pretty clear. First, use their massive brand name to get a leg up. The really interesting part? They're going to target states where online sports betting isn't even legal yet, which is a massive opportunity. And they also said they're going to be really careful here. Data-driven, conservative, and they expect to make their money back on this investment a lot faster than they did with the original sportsbook.
Okay, so that's the whole story of the call. You have the bad numbers, and then you have management's really bullish story. So where do we land on all this? Let's get to our final analysis and what we call the next call.
First, let's talk about that guidance cut. And yeah, there's no sugarcoating it. It was a big cut. Revenue expectations down $300 million and adjusted EBITDA down $350 million. That hurts. But the way to look at this is that they've just reset the bar. They've lowered expectations so much that now it's going to be a whole lot easier for them to come out next quarter and say, hey, we beat.
So before I give you our official rating, just a quick definition. When we say market perform, we just mean we think the stock will probably do about as well as the broader market, say the S&P 500. The risk and the reward, they feel pretty balanced.
So, with that in mind, we're officially rating DraftKings a market perform. Look, the bull case is strong. You can't ignore the core growth or that huge $2 billion buyback. But at the same time, that Q3 miss was a stark reminder of just how volatile this business can be. And this whole new predictions thing, well, that's a bit of a wild card. So for us, it feels like the potential upside and the downside are pretty evenly matched right now.
So, what should you be watching for going forward? Well, for Q4, expect more of the same volatility, but keep a close eye on user growth and how much of their business is coming from parlays. We think the stock will probably trade sideways for a bit. The market's going to want to see that their hold percentage gets back to normal before it gets too excited again. And the big things that could move the stock, the launch in Missouri, how this predictions product rolls out, and of course, the results of the NFL playoffs. And that really brings us to the final lingering question here. The market completely forgave them for one really bad quarter because it bought into the long-term story. But will it be so forgiving a second time? What happens if that hold volatility bites them again in Q4? Or if this new predictions investment starts dragging down profits? That's the real question. And it's the biggest risk for anyone holding the stock right now.
And as always, just a reminder that this is for informational purposes only and is not financial advice.